Okay. Thank you, everybody, for coming on such a beautiful evening. I know it's tough to come inside, but thank you so much. And just like to start off and, as of course, introduce our team. Michelle Blood, Angel Belcher, Jeremy Brown, Dominic Piazza, someplace in here. The story on Dom is he came into the office last September with a backpack and a one-way ticket to Vietnam, and he just got back a couple of weeks ago. The beginning of the trip actually spent with Lane Brown, who's our audio-visual professional here tonight. And so at the break, you can ask Dom, get some stories out of him. David Wild, who runs Delano Capital, is here, and you're probably going to want to talk to David at the break as well. He's had an extraordinary year this year, way outperformed us. David, what are you up this year? He doesn't know. Okay.
Tell me Saturday.
Let's see. Our star intern from last year is here someplace, Jordan Christian. And we got a few people here that came in from out of state. There's Paul Stafford, came from Seattle. Matt Stafford from Salt Lake City. And then the California contingency, Bob Ternosky, Mike Tavey, Ed Alvarado, Greg McCombs, and Mike Worthington are all folks that I actually went to high school with. In fact, Bob and I were in, I think what was called a fraternity back then, or club. I think now they would call it a gang, right, Bob?
You're supposed to be impressing your clients.
Okay, so sort of reverting back to Jeremy for a second, we had a project last year that occurred last winter that Jeremy undertook, and it was really the most selfless act I've ever experienced. That Jeremy worked to donate literally thousands, if not tens of thousands of garments and winter clothes to folks in need all across western Montana. And in an era where there's very few selfless acts these days, it was super, super impressive. And there are several times I asked Jeremy that we should just hire somebody and complete the project. And he said, no, I'm doing this myself. He had some, actually, Lane, again, our audio-visual professional, documented the project, and we're going to show a little video. So this all started with Jeremy took a trip to investigate one of our companies, SEI, at an analyst meeting. And this all just sort of, in the typical Jeremy fashion, just unfolded. And Jeremy, you want to kind of give some background on what all occurred?
So I didn't know that they were going to do this.
Yeah, no, by the way, he had no clue we were doing this.
I went to SEI, this company, that totally cool company that we invest in, and connected with a guy that was there. We chatted. He overheard that I was from Montana and went to the University of Montana. It turns out he was an alumnus of the university, and so he kind of was asking me about how Missoula was, and it turns out this guy not only is the son of the founder of SEI and either a current or future board member of the company, but he also has his own apparel company that he kind of started from scratch. And he, one thing led to another. We kind of chatted all weekend, and he eventually said, "Hey, do you know anyone that could facilitate donating about $2 million worth of outerwear clothing to people that need it in Missoula?"
How many boxes, Jer?
A lot of boxes. He shipped from his manufacturing facility in LA. He shipped up his holding facility in LA. He shipped up probably 17 pallets full. They were laying probably 6 to 8 feet high each, full of boxes. So it was about half of a truckload of clothing. This is all kind of high-end outdoor winter gear, and he wanted no recognition. So Russ makes it sound like this was my thing, but it really wasn't at all. It was this guy, Palmer West, whose company, Ether Apparel, has been in business for about 6 years. He has about 6 years worth of old inventory. Most high-end clothing companies will burn or kind of destroy, cut up with scissors, their inventory because they don't want it kind of floating around and diluting the marketplace. This guy wanted to donate all of it, and so he sent up all this inventory. I kind of bit off probably more than I could chew. Thanks to Kirby, who I just walked in, donated the forklift.
And his son Carson had the warehouse that was used.
So I was driving that forklift. Lane was filming and quickly realized that we needed about 30 other people to come help. So we got a bunch of volunteers to help kind of distribute the stuff, and we distributed to 40 different organizations, mostly schools and nonprofit organizations in the Missoula area, some outside of Missoula, some in Dillon, and a few on some of the reservations.
How many pieces of clothing would you estimate?
A few thousand.
Easy.
Yeah. Lots of clothes. I don't know if you want to know anything more, but that's the story.
Pretty awesome.
Thanks to Front Street Capital for letting me take about 3 weeks off work this year.
The poor guy, oh my God. And then, as you know, we've got T-shirts. Michelle, you want to give a little instructions on the T-shirts?
Oh, they're just for everybody. And if you don't find your size, let me know and we'll make sure you get one.
Yeah, they're all in the back table back there.
Wear them around.
Yeah.
You just introduce the person behind you.
Oh, yeah, we talked to Michelle, or Ginger, I mean. Okay, so let's dig in here. We're going to kind of start this off with really the same piece of information I think we might have done last year. We might have even done it the year before. It doesn't matter. It's just the most important thing that we could talk about, and we think it sets the mindset that's so important to have any success in investing in publicly traded securities. Nothing is more important than we're going to talk about. And again, I'm going to start with a quote that we've used before, but it leads in as well as anything that I can think of as to what is so important tonight. And that is Warren Buffett has said that the market, like the Lord, helps those who helps themselves. But unlike the Lord, the market does not forgive those who know not what they do. So the idea is to try to make decisions based upon variables that you can know what the probabilities of success are. And we think the vast majority of investors spend the vast majority of their time deliberating and making decisions on a set of variables that have literally no predictive value whatsoever. None. Zero. And so we think to be successful, we could flip to the quality and price. We think to be successful, one needs to identify what it is that you can know. But we think way more important is to identify what you don't know. And the way you protect yourself from what you don't know is to make sure you get everything right possible that you can know. And never, ever, ever override what you do know with what you don't know. And so we think the majority of investors base their decisions on a bunch of variables that literally have no predictive value whatsoever. And in that category, we put all geopolitical and macroeconomic events. So we had an election a year and a half ago. We got another one coming up in a few months. We've got tariffs they're talking about for China. Italy was going to malfunction here a few weeks ago. Brexit here about 2 years ago caused a lot of concern. The growth rate in China, or how China's going to react to different variables. Greece fell off the planet here a few years ago. All of these variables, it's interesting and it's fascinating to think about, and if you could go to a cocktail party and talk about it, makes you sound super smart. The problem is that it has no predictive value whatsoever. There are too many variables. And if you get zeroed in on a particular variable, like, the problem that just arose not too long ago in Italy, and then something else happens, half the globe away, by the time the dominoes get to what you had figured out, any estimate that you had is off the table. And so the issue is, and I'm not sure, it's both the problem and the opportunity, is that the vast majority of investors make their decisions based upon these variables. And actually, the more intelligent one is, the more they're drawn into that. Because they don't want to just get bobbed around in the waves. They don't like the idea that there's fluctuations they have no control over. And they have a belief that they're smarter than most people, so they ought to be able to figure it out better than anybody. The problem is nobody can figure it out. It's a loser's game. And not only are intelligent people drawn to it, but the larger the pool of money that you're managing, the more they think, well, I ought to be able to just pay somebody to figure this out. And they pay tons of money to people and come up with the same poor conclusions. And I'm telling you this from experience, by the way, that there's a point in your career, if you're deliberating on short-term geopolitical macroeconomic events, there's a point in your career where you wake up and you go, God, I don't know what I'm doing. And this is super frightening. Unfortunately, these people don't quit their jobs. They push it in the back of their mind, they go back to work the next day. And the decision-making becomes even more emotional. And this whole thing just feeds on itself to the point to where the stock market fluctuates fairly violently based upon a whole bunch of variables that we have absolutely no control over whatsoever. And for most people, that is not a palatable idea. So, and to make matters even worse, the stock market is a pari-mutuel system, which means it's like the racetrack, that the favorite horse has the lowest odds of winning. So you could actually even figure it out, and then actually prices could move against you because it's already built in to the valuations. And so not only are the variables completely unpredictable and the equation unpredictable, but you get this pari-mutuel system that really totally throws it into no man's land. Jeremy, you got anything to add?
Nope.
So, in our opinion, is it any wonder that most people cannot stick with an investment plan, and most people feel the stock market is not a place to put their hard-earned capital? And we understand that. So let's talk about what we can know. So we think all the stock market is simply a place for you to buy a business. And it is nothing more complicated than that. So if you bought any real estate, it's basically a Zillow for businesses. And there are hundreds, tens of thousands of businesses to choose from. And so we think if you're going to buy a business, then you're going to use the same two variables that you're going to use to purchase anything. And that would be the quality of the merchandise and how much am I paying for it. And we think over time you could become quite good at that. That you can identify exactly the type of business that's going to have some significant advantage over their peers. And we think the beauty of this thing is that the knowledge is cumulative. Being a business analyst, you actually get better and better all the time. And there aren't that many things in life where you actually get better all the time. And in the macroeconomic arena, we don't think the knowledge is cumulative at all. You know, if you actually figured out what was going to happen with the North Korean situation, is it going to do you any good when it looked like Italy was going to default on their debt? You're basically riding on a treadmill. You're never picking up ground. But evaluating businesses, we think you get better and better and better. And we think as time goes on, if you work at it hard, that as time goes on, you can create a criteria. You can identify exactly why one business would have a significant advantage over their peers. And we think as time goes on, that becomes clearer and clearer and clearer. And we think at some point, they stick out like a sore thumb. Oh my God, that's exactly the target. That's exactly the type of business that's going to have this huge advantage over their peers. Once you do that, and you can see that with total clarity, not ambiguous at all, then all you need to do, as far as the valuation, is look at what that company is earning today, and then look out into the future and make some determination as to what the trajectory of that earning stream is going to look like indefinitely into the future. And you're going to probably pull in some maybe macroeconomic stuff. I mean, if it's a cyclical business, where they might be in the cycle, are they earning more money than they would at the bottom of the cycle? There's all those variables that you're going to build in to see what the growth rate of that cash flow stream is going to be. And so we think that if you can know exactly what you want to own, and within a pretty narrow range, identify what would represent a fair price to pay for that business for somebody who's going to own it for a long period of time. And you could see those two things crystal clear. Then we think the more hideous everybody else's behavior is in trying to predict the short-term fluctuations of the market, the better it is for you. And once you accept that the short-term fluctuations you have no control over, once you accept that reality, this thing becomes a ton of fun. Because they offer prices from time to time that are just so much in your advantage, it's almost silly. If you could detach yourself from all that malarkey, this thing is very, very effective. And we think we have been able to compound returns by owning great businesses and buying them at reasonable prices is a great way to compound money. Jeremy, you want to add anything?
We could talk about our criteria. We could give some examples, but I think you're doing great.
Okay. So should we slide into questions or?
Sure. If anyone has any particular questions, or we can talk about our criteria.
Yeah, why don't you put the criteria up? And so what enables us, we think, to see something crystal clear, or why one business would have a significant advantage over their peers, it's based upon a management philosophy. That if a company behaves in a certain manner and uses these criteria to what we believe unleashes the best in the human potential. And if they do that consistently, that they will develop a culture that can live and breed on into perpetuity. And that's what gives us the confidence to be able to identify these companies, find a fair purchase price, given the wild fluctuations of Mr. Market in the short term, and then hold these securities indefinitely. And so let's kind of open it up for questions here. We can, whatever comes to mind, we can talk about the criteria. We can, yeah, Elon.
Yeah, just before we get into criteria, I am interested to hear about some of that. What I'm hearing is that your approach works because a lot of people in the market don't think like that. And if everybody was wise or correct, followed your advice, it wouldn't be profitable.
We would have no advantage.
You'd have no advantage.
We would have no advantage.
So, should we be thankful to all of those people?
Well, the interesting thing is that understanding that you're only buying a business, unfortunately, doesn't come naturally. And it didn't come naturally to me. It comes naturally to nobody. It didn't come naturally to Warren Buffett. Somebody has to sit you down and explain it to you. And when that occurs, it's an epiphany. It's like, oh my God, what was I doing before this? How did I survive before this? And from that moment on, the knowledge starts to build. You start to learn. You get better and better. It gets tighter and tighter. And it becomes more and more and more and more and more fun as time goes on. And there's a lot of really, really smart people trying to make money in this system. Oh my God. And there is, like as Elon described, there is no way that one is going to wake up every morning and be smarter than everybody every day. It will never happen. It's a loser's game. So what you have to do is to be able to look at the same information that everybody else is looking at and come up with a different conclusion. That you're looking through everything through a different prism. And it's not complicated. It's a mindset. And again, Buffett did the same thing. The only difference was he started investing when he was 11 years old. And he read Ben Graham's book when he was 19, and it was his epiphany. And he immediately transferred to Columbia Business School to take courses from Ben Graham, who really solidified this idea that you're just buying a business. And so Buffett has said this again and again, that it's not the IQ, it's the discipline. Without the discipline, the IQ is going to bring you into no man's land. It's going to lead you off of a cliff eventually someplace. It's the discipline that you're only buying a business that's going to get you there. Now, if you get the discipline and you get it at an early age, and then you take a ton of IQ and layer over the top of it, you get Warren Buffett, the richest guy on the planet. But it's without the discipline, it would be a lost strategy.
I've been
Yeah, Bob?
I've been with the firm real quick for 2 years now, and the people that I work with are super smart, but the thing that sets them apart is that they have a laser focus on what it is they know and what it is they don't know, and they do not try to do something that's outside of their circle of competence. And it's that discipline that makes them so successful and has made them so successful over many, many years.
Not the first quarter.
But that's the point. It's the discipline to see what it is, to see those fluctuations, knowing that sometimes things go up and not getting too elated, and sometimes things go down and not getting too dejected, and not letting that affect your decision-making process. That's the thing that these guys do so well.
So when news comes out that is geopolitical in nature, that's negative, and prices go down, we only see two things. We know the company, and now the price is cheaper. We see nothing else. Nothing else. Bob?
So getting down to brass tacks, what kind of companies do you invest in?
These companies. Really, normally, some of you haven't been to this meeting before, but normally the majority of it is, questions about the companies and why we own them and what they're doing recently, and we'd certainly like to open it up. And what this is the holdings in the Tarkio fund, right? From highest percentage ownership down to the smallest.
So are we talking about billion-dollar, multi-billion-dollar companies, or less than $1 billion?
Yeah. So the term that is used in the business is small cap or micro cap, small cap, mid cap, and large cap. And our two criteria is the quality of the company, which is based upon the management criteria that we had on the last slide, and the valuation, or what the price of the business is selling for compared to what the potential cash flow stream is in the business. And the size of the company is not one part of the criteria.
Okay.
So they could be very large companies or they could be very small companies. That said, all else being equal, and as we know, all else is never equal, we would rather have the smaller company than the larger company because they have the ability to grow at a faster rate than the larger company. But in many cases, the sheer size of the company is going to give them an advantage. So we have a mixture of small, mid, and large capitalized companies, or CAP as they call it. And really one of our favorite companies, that's Cognex, very theatrical in nature, and we've talked about it before at these meetings, that They're an interesting situation because they have very high profit margins. So there's the size of the company based upon their sales is not as comparatively not as large as if you just looked at their earnings. So it's hard to put them in a group. Are they small cap? Are they mid cap? Are they large cap? It's a little hard to put them in a category because of that, because their profit margins are so large. And so they asked Dr. Bob, who's the founder of the company, on a conference call once, whether he was a small cap, mid cap, or large cap company. And his answer was, we're a mad cap company. That's exactly the answer I wanted to hear. Elon.
I wonder if we could go back to the criteria.
Love to.
Yes, and as you talk about these, there's a lot of what you're saying, and particularly in terms of discipline and not considering these factors that you can't really you can't predict. A lot of this sounds like a pretty mechanical operation. If you want discipline, you can have a computer. A computer can be very disciplined. What do you, as a person, bring to each one of these, or some of these, more than others, I imagine, in making your decisions about why can't we just have a computer?
Yeah, I think you're right. The process the disciplines are very mechanical, and this is the opposite of mechanical. It's totally humanistic. And in fact, the core of this was developed by a fellow by the name of W. Edwards Deming. And Deming went to Japan after World War II, and the Toyota business model was developed around Deming's ideas, and the entire Japanese business system was created around Deming's ideas. And when Deming started out, he was a statistician, and he created something called statistical process control. Where you take a, Jeremy.
Here you go.
You take just a standard deviation, and somebody is working in some aspect of the manufacturing operation, and what Deming devised was a way to measure where the outcomes were coming in on any process that was going on in the manufacturing at one point in the manufacturing process. And Deming's idea was that as long as it had a normal distribution, that it was okay once in a while to have a reject. That was something, if you eliminated these rejects here, you would waste way too much effort into the system. The idea is that whatever you do, there's always a certain amount of shrink, right?
Yep.
But it would be minimized. So the idea was that they had this measurement thing going on, and he was just a statistician. And look at him; he's a socially awkward gentleman, as I would describe him. But then he came to the conclusion: well, if we could measure this, and suddenly, if the whole curve started to shift, then the next thing that you still wouldn't have that many rejects. But if you could see the whole curve shifting, then eventually this thing's going to lead and you're going to have all rejects. And so his idea was to identify when the problem was getting off kilter, as soon as at the earliest stage of the manufacturing process. And then if you did that, then everybody would be kind of a quality control inspector themselves. And if you did that, you caught the defects before the value was added to it. And so then he goes, okay, now I understand when the situation starts to move, when the situation, I can see when it starts to become off balance. But then what do I do? And he figured out, well, oh my God, it's people that are doing this. And he went from being a hardcore statistician to developing all these touchy-feely, humanistic concepts to break down barriers, drive out competition, empower employees, long-term focus, all these, very humanistic ideas. And he did it because he was just looking at it rationally and figured out, oh my God, it's people that change the process. And it's human behavior. And that led him into where his work eventually developed into. And then to just go on with the story for a second, so then the idea was if you catch the defects at the early enough stage and you have somebody right there that can bring it back into line, then you should have a process where you have no defects that go to the next station. And so then the idea was that if you worked and if you created all of these humanistic incentives, and then at the end of the line, the objective was that you would have no inspectors. Everything would be perfect as it came off the line. And that's the Toyota story. In the United States at the time, was that the way that you improved your quality was by running things through as fast as you could and then having more inspectors to catch the defects on the back end. And so as the quality got better, the cost went up because you're throwing more stuff away. And you keep hiring more and more inspectors. Where the Japanese were doing just the opposite. As you got better and better, it's actually a little slower process. But if you empower your organization and you have people communicating with each other freely, then you're getting better and better and better all the time. And so what starts out as a slow process gets a little faster all the time. A little bit faster, and a little bit, the quality keeps going up a little bit and gets a little faster. And so simultaneously, the cost would go down while the quality went up. And is it any wonder that it took the U.S. auto companies decades to even come close to trying to catch up with where Toyota had this huge lead because they just kept getting better and better. And the Japanese call that continuous improvement Kaizen.
So a quick
You write it up there, Jer.
A quick word about Kaizen. Kaizen, which is Japanese for continual improvement. So when we look at companies, as probably everyone in here knows, we're super, super long-term investors. So if we look at a company, we want to own it for as long as we can possibly own it. And if we own a company for a long time, we expect that company to also be long-term oriented as well. And if they can be long-term oriented and they can practice Kaizen, which is minor incremental improvements which over time add up and add up and add up and add up and aggregate and become major improvements and major shifts in quality and improvements in quality. If we can get a company that can do both of those things, that can practice Kaizen and do it for the long term, then we like those companies. And we especially like those companies that can do the Kaizen through these two things: cooperation rather than competition, and employee empowerment. And the reason is this: if you can empower your employees who are the lowest level or have the most knowledge or are at the decision making, at the problem or at the issue or at where the rubber meets the road. So that means if you're manufacturing, if you can empower the people that are line workers, or in your sales, if you can empower the salespeople to make decisions, or in your design, if you can, empower the people who are doing the CAD drawings to make decisions, and create a culture where they are not afraid to make mistakes, then they'll take on more responsibility. They're the ones that have all the information in the first place. They're going to make better decisions than their managers are back, at home base, who don't have all the information. And when they make mistakes, they actually learn better. So if you allow them to make mistakes and you create this culture where instead of punishing employees for making mistakes by lowering their compensation when they don't make as many widgets, or by reprimanding them if they do something wrong, you create a culture where they're actually encouraged to make changes and to make mistakes. They'll learn more, they'll become better decision makers. You'll have your decisions made at the point where the information is the greatest. So again, better decision makers. And then if you can do all that, and you can do this other thing, cooperation, not competition, you can break down barriers between employees in the organization, or between divisions, or between employees and managers, or even between employees within the organization and suppliers or customers or communities. If you can do all of that, then the organization can take all this information that they're getting at all these touch points, and they can collaborate and spread information. They have an incentive to spread information across the organization.
And we actually try to behave this way inside of Front Street Capital. And if you talk to other people in the business, it is literally, this idea that people get, that if people are empowered to do their job and they freely communicate, and if anybody's been to our office, we have no walls in our office. If you talk to anybody in the industry, what we could produce, what we can accomplish with 5 people in that office is unbelievable. And particularly, we're going to call out Michelle and Ginger. Oh my God. And it's just fun to watch people grow and learn and get better and better and better. Dixie.
So I understand, and I'm hearing that you identify a company with long-term investment potential, and they have all of these qualities. But companies evolve and change. They get new leadership in. When do you decide that they no longer meet these criteria and it's time to unload them?
Yeah, it's not black and white.
It
It's in shades of gray. So I'll give you a good story. You want to flip to the companies again for a second? We've owned Campbell Soup for a long time. The Campbell Soup story is based around a fellow by the name of Doug Conant, who came into a very awful situation. When Doug came into Campbell Soup, they had barbed wire around the facility. It was in Camden, New Jersey, which was a real rough part of town. And he came in and recreated that culture. And it took him a good solid 10 years. That's turning around a battleship. And he was we loved Doug Conant. And then he tragically got in a car accident and had to move on and had to retire. And then they brought in Denise Morrison, and we liked the things that she was doing. I think I had a little bit of soft spot for a female CEO, and I liked her methodology. I was a little bit bothered that she never gave Conant as much credit as I think that you normally would for somebody that did what he did, but that's okay. And we were okay with Campbell. We didn't aggressively add to it. We have companies that we felt stronger about, but we held that original position pretty much through thick and thin, with the exception that Campbell Soup, consumer products companies, staple type companies, when the stock market goes down, they normally hold their own. Because in a recession, everybody's still going to, eat soup or whatever. So we used it as currency a lot of times when things got on the downside, because it would normally hold up better. So it's wore down a little bit over time. And then 3 weeks ago, they fired Denise Morrison. So, I'm 2 CEOs detached from Doug Conant. Now, I don't know who they're going to hire. We're probably going to wait around to see who they hire. But that's a story where it's, piece by piece starts to, go, in from gray and then all the way to the point where we get more aggressive to sell it. And always, every day I kind of look at what's going on and evaluate the portfolio based upon the qualitative factors and which companies that we feel the strongest about, and then which ones are selling at prices that might be cheaper than another one. And there's, we'll shift around a little bit, particularly more so in the fund than in the private accounts, to shave off, one that's, going into that gray area into one that's just getting brighter and brighter and brighter, and that happens to have fallen down for a particular reason or another.
I think somebody just bought Cattle Soup.
Well, there's rumors that they're going to get bought out, but nothing substantiated yet. And it could definitely be, the where this thing leads to, and we'll evaluate it at the time.
They're not still putting all their soup in cans, are they?
They use different packaging, yes. But it's the entire center aisle of the grocery store has been under a lot of pressure and has been a tough business for the last 5 or 6 years. And they've tried to get out of that, and she was very proactive in getting into more fresh foods, and she really gave it a try. And a couple of things didn't work out, and then they just canned her. It didn't. Oh my God! That was totally unintentional. I wouldn't have used a pun that bad. I really wouldn't.
Nice one,
You got a pun to add on top of that, Jerry? Come on.
What happened to Valspar?
Oh, they got bought out by Sherwin-Williams. It was a total cash deal and was a large capital gain because we had owned it for, I think we bought it in 1991. So that for those of you that had to pay taxes last year, that was one of we had 3 companies get bought out for cash: Whole Foods, Valspar, and
Century, or level 3,
Level 3, yeah.
half of it.
And
Yeah,
there's
half of it.
no Toyota on there.
No. We owned it for a while, probably 10 or 15 years ago, maybe 15 years ago. We started to build a position, and the accounting barrier was uncomfortable to me. I spend a lot of time on conference calls. And I like to get the inflection. And most of the CEOs or the managers I've met, and then I get on a conference call and I get a pretty good idea of who they are, and I can understand and their inflection and their voice. The conference calls are pretty important aspect of what we do. They all had a translator on them, and they took 3.5 hours. And finally, it just I just couldn't get attached enough to the situation, and finally I gave up for that reason. And I kind of still regret it to this day, but yeah.
Hey, Russ, I think I need to start repeating questions.
Oh, yeah.
Yeah, sorry about that.
Way to go, Jer.
Yeah, I'd really dropped the ball on that.
Sorry, Jarl, wherever you are.
Who's on your hot list that you are investigating and evaluating right now to add to the fund?
So the question is, who are we looking at right now? What companies are we looking at now to add to the fund or to the portfolios?
There's probably several ways to answer that question. The first way that I heard it, I'll answer it, and then I'll answer it in a different way. The first what I heard originally was, which are your best companies, and are any of the best companies, happen to be selling at a price that we think is super compelling? And our 2 best companies, Cognex and Rogers, which have been our 2 biggest winners for the last 6 years, 5 or 6 years, finally had a meaningful correction this year. And both of them, Cognex, our original cost in the fund, which has been 6 years ago, was $8 a share. Stock got up to 77 and is now selling for 44. And that's about as compelling for us a valuation as we normally ever see with Cognex. And we think that that they have one of the best cultures, if not the best culture. They have a brilliant CEO that is handling a very challenging situation, which is the founder, who's created the culture. But oh my God, managing this guy is he's doing this brilliantly, and they're in an industry that it's machine vision, so it's computers that can see, and they make the software that enables the computer to the eyeballs for the computer, or the brain actually, that takes the information and makes judgments. And it's a duopoly. They and their competitor, particularly them, have blown everybody else out over the last 15 years. And they have 20% after-tax profit margins. Stock sells for 44. They have no debt and about $7 a share in cash. It's just a battleship. And we've been trying to get it's the second largest position in the fund, and we've been trying to actually add as much as we can to it. But we still have to be prudent. There are compliance issues with getting too overweighted in any particular security.
What about the other question that you heard, which is, are there any?
Yeah, it would be a
companies
new
left?
situation. Problem with a new situation, we're not going to know it as well as Cognex. So yeah, there are new situations, or newer situations, but we're not going to have nearly the kind of confidence that we've had with a company that we've owned since 1992.
Russ, maybe to follow up on that, can you explain how you, maybe the methodology you use to kind of start to look at and then start to bite on and then really pounce on?
Yeah, there's kind of back to Elon's question. Traditionally, and we have a lot of admiration for pure, true value investors. And what a value investor traditionally is known as, and this was Warren Buffett's primary mentor, Ben Graham, was the idea that you're buying a reasonable company, but you're buying at a really, really cheap price. And some of the greatest track records of all time, and Warren Buffett's, the first third of his career was done in this pure valuation sort of methodology. And what the process is that you just go through income statements and balance sheets, and then you compare it to the price of the stock, and you look for things that are statistically cheap. And then once you find something that's statistically cheap, you do a qualitative analysis to find out if the company is basically survivable, that they're going to survive whatever terrible situation that they found themselves into. Their balance sheet's okay, the business is solid enough, they'll get through it, the stock goes up, you harvest that and you buy another one that's cheap again. And it's over time has been the most effective way to invest. Except for about the last, what do you say, David? 6 years? 10 years?
5 or 6.
5 or 6 years? For some reason or another, the great value investors have not had the greatest track records for the last 5 or 6 years. And we think it's because that they're screening for these things on the computer. And the beauty, could you go back for a second to the criteria? Can't screen for this. Just can't do it. No way to screen for it. So it's just every day we come to work and we talk to people and we talk to our companies and we listen to conference calls and we read everything we could possibly get our mitts on, and we are involved with any kind of organization that promotes these kinds of management philosophies, and we're just absorbing stuff all day long. And then once in a blue moon, we see something that is the hook. And an example would be, I don't know, maybe, when is it now? It's almost 20 years ago now. I read an article in the Wall Street Journal about this company called National Instruments that had a 100-year plan. And the CEO, Dr. T, who was formerly a professor at the University of Texas, was in his mid-50s. I go, okay, that's a good place to start. And the more we found out that this was the real deal. And as when we started to buy a little bit, and they reinforced, and the way you really understand, I mean, you can kind of learn about a company, but the great thing about being a very long-term investor, is that over time you actually get to know them. So you can sort of think you know something, by working on it for a month, but after 3 months and 6 months and a year and 2 years and 5 years and 10 years, even I can figure it out. And we still own National Instruments today.
So, just out of curiosity, on the next slide, how many of those companies are older than 30 years old?
So the question is, how many of our
Do you have that other
portfolio
slide?
companies are over 30 years old?
Oh man, is that?
Yeah, I got some.
I think the gauntlet is in there. So here's one 1988, one 1998, Herman Miller 1997, Costco 1997, Corning 95, Cognex 92, Berkshire Hathaway 92.
I'm not asking when you bought it. I'm asking the date the corporation was incorporated.
Oh,
So, for instance, Amazon is, less than 30 years old. Costco is less than 30 years old.
they might be a little longer, but yeah.
Campbell's, probably maybe 100, 80.
Yeah, Rogers is almost 200 years old, I think. 160 years, maybe. But our criteria is the management philosophy, and then the price, and not how long they've been around. It wouldn't matter one way or the other than the fact we need enough time. We would never buy an initial public offering, because there isn't enough history to live with it, to go back and pretend we lived and simulate that we lived with it for a while. Does that answer your question?
Yeah, so like, shares of Apple, if you got in at the ground floor, hugely valuable. If you got in the next 5 years, also pretty valuable. So at what level of success, you're talking about this one national who has a 100-year vision. So I guess my question is about, are you also looking in that, a company that is cutting edge, that is like, doesn't have a track record per se, but
We would not buy something that doesn't have enough of a track record where we can, could you go back to the criteria? Where we can identify these principles. Now, so a good example, actually, well, let's go to the probably where you're getting at here, would be maybe Amazon and Google. And I am totally guilty. There was probably enough on Google that they fit the criteria, and I didn't act. And there was probably enough on Amazon to where they were so long-term that they were so long-term, and they do this so effectively that the rest of it was probably might not have mattered as much, because what they did here was as brilliant as anything you could imagine. And I just flat out missed them both. And I would say Google, in retrospect, was an error of omission.
And maybe to directly answer your question, or hopefully I will, the fact that Amazon isn't that old doesn't really mean that they're not long-term. It's you can see from their, from their management on down, and from every statement that they make, that they are long-term oriented, even though they haven't been around for very long. Their goal is to be around forever.
And again, our criteria is this, and they're getting in at a fair price, and has nothing to do with trying to find something at the ground floor. We're delighted to get in on any floor as long as they behave this way and the price is very, very fair with a margin of safety for somebody that wants to own that business for a long period of time, based upon what the cash flow would look like, the trajectory of the cash flow over a long period of time.
And if I can just quickly go back to this point about Kaizen, and Kaizen through these types of actions and culture, and that is that if you're truly continually improving, then the thought is you're always going to be better in the future than you were in the past. And if any lawyers in the room other than me, this is probably not a good graph to put on in an investor meeting. But this is not supposed this is supposed to represent nothing more than just the improvement of performance of a company, irrespective of stock price. Our companies, we're hoping that they get a little bit better and a little bit better and a little bit better, but after a while, those little increments add up, and they keep getting better and better and better. So we want our companies to look like this in their trajectory, which means that if we're at any given point, like let's say we're at time 1, we're expecting that at time 2 they're going to be better. But that doesn't mean, unlike many investors, that doesn't mean we want to sell at time 2 and kind of get as Russ would say, harvest the benefit of that capital gain or of that performance gain, because we think that over time they're going to just keep getting better. So even though Amazon might be, it's a relatively young company, has a long-term focus, and we're okay with that. We would be okay with a young company having a long-term focus. We're also okay owning a 200-year-old company that continually improves, because we think that in the 201st year they're going to be better, and in the 202nd year they're going to be better. And that's kind of what happened.
Yeah, I mean, when Doug Conant came in, they were a lousy company. And then he came, and it's an old company, and he comes in, and there's a whole new trajectory that comes in from that point on. And actually, in retrospect, if I had perfect vision going forward, I would have preferred to wait about 10 years to own Cognex. I think that in retrospect, it was too early. There was a lot of competitors, and I'm very fortunate that we were able to identify a company that could start out in an industry with 200 competitors, and then eventually whittle it down to 2. In retrospect, the odds weren't really that strongly in my favor. If we would have gotten in later, after some of this had already gotten weeded out. But I didn't have that. I'm a little smarter in that regard today than I was back in 1992.
What'd they do, buy the other companies?
No, they just, they're so much better, they all went by the wayside. Yes, Grant?
In your narrative, you talked about how important people are, specifically the CEO. That's not one of the...
I wouldn't say specifically the CEO, but go ahead.
Well, the examples you've given of often been CEOs,
Yeah.
The people, I'll say.
So
I don't
the,
see that as a factor there. How much of a factor is it for you?
so the question is, how much of a factor are CEOs and other people inside the company? We don't specifically list that on our criteria.
Yeah, so actually, I would, I mean, it's, we had one company, Gentex, to where the founder hired a CEO to run the business, and he never paid him very much. And there was a classic case at that point in time where he made a very public issue out of it that he didn't get paid enough, and Fred Bauer just let him go. Because Fred believed that the value in the business was not the CEO. It was the culture and everybody participating in a culture where everybody it was empowered and communicated, and the CEO was more of a coach than and that really inspired me to take a large position in Gentex and own it for a long period of time. I mean, there are other cases where, like I said, this guy Rob Willett has done a fabulous job of maintaining a terrific culture at Cognex. But in sort of, Dixie, in answer to your question, he's not there anymore. Where was I going with that?
You were talking about Rob Willett being a great individual leader, CEO, but maybe the culture of the company might be more important than that one figurehead leader?
Yeah, so, yeah, I mean, if the CEO goes, it's not an issue to immediately turn negative. Most of the cultures are going to live and breed on if they're done properly. So the culture is way more important than the leader. Get a good leader. I mean, we certainly appreciate it.
That said, I would say one of the things that I've learned the most since I've joined the firm is that it's hard work to create these cultures and to maintain them, because people naturally start to get competitive with each other, and it's hard to keep the barriers broken down, and the best leaders tend, of the companies that we're looking for, the companies that have the leadership that we like to see, tend to be companies where the leaders, instead of making decisions and being good at making decisions and knowing what the right thing to do is, they're very good at creating cultures, and they're very good at creating structures where others can do that.
And the big issue is why it's so difficult is because all these things cut across normal human nature. Human nature is to take the shortcut. Human nature is to be competitive in every aspect, particularly in our culture. Human nature is to tell somebody else what to do. All these things cut across human nature. And so it really is this process of changing a culture. And then once it's changed, it's hard to unravel it. I mean, it can happen, and that's why we think we have a long lead time on identifying companies that we need to start to pair off as time goes on. Should we do a break, or?
We have a couple more questions.
Yeah, Mike.
I just wanted to point out that you're changing cultures, and part of what Deming was doing over in Japan was changing the culture of the American mentality of the bean counter, and instead making the quality of the product the forefront. And I'd like to point out that Deming is one of the 4 founders of, there's an association called Project Managers Association. So to get your PMC license, part of what they teach is Deming's philosophy. He's one of the people that talks about quality control and how important it is, and what you're doing is empowering the employees to help quality control. So these companies that Russ is investing in is very quality one of the features is quality control.
Yeah, talk about the bean counters. Deming's idea was that it's about the process. It's all about the process, and the results will take care of themselves. If you make the process as good as it could be, and if you're totally focused on the process, then the result is going to be as good as it can be. Whether it happens to be at some level that you pulled out of the air or not. And that you should get, if you get your gratification out of watching the process get better and better, then you're going to enjoy your work every day. And our experience has been that if you just focus on the process and not the results, you wake up one day and you go, wow, look at the results. They're way beyond they would have been if I would have picked some fictitious number out in the air someplace and then been disappointed when it got there, or been disappointed when I reached it, and then what do I do? But if you focus on the process and you get better and better all the time, then you get gratification every day out of watching things get incrementally better. And Deming's idea was no goals. It's all process oriented. John?
I noticed that CenturyLink's your largest asset, and it by purchasing level 3.
Yeah.
Yeah.
Partially.
And you were always bullish on level 3, like the culture. You like the culture of CenturyLink.
So the question is, CenturyLink is our largest holding in the Tarkio Fund. CenturyLink was purchased level 3. We were a long-term owner of level 3. We love the culture of level 3. Do we like the culture of CenturyLink?
CenturyLink was a terrible company. And the leadership at level 3 within a few months has taken over the CenturyLink business. And so we think it's an improving situation almost daily. And there's a lot of room for improvement. And beyond that, I've had somewhat of an addiction, I guess. Got introduced to fiber optic technology back in 1988, when really it was just a dream as to what could transpire. And I've just watched it step by step all come true. And it was based on a company called Raychem at the time, which actually had a fiber optic sort of a scheme that almost took the company under because they were 20 years ahead of their time. But I've just got this knowledge base, for better or for worse, with fiber optic technology and telecommunications, and the power of if you start adding information on top of information on top of information faster and faster, and could connect people more effectively, that the benefits to society are so enormous. And we think for that reason it'll always be a tremendous area, and we think we're still in the early stages of what fiber optic technology can actually do. And so we've had this strong interest in fiber optic technology, and particularly we are very, very, very excited about owning the fiber in the ground. So a big piece of level 3 and now a big piece of CenturyLink goes beyond this criteria, and that is the asset that we're buying. Because the reason why we think it's so powerful is because it's a fixed cost asset. Cost a lot of money to dig up the streets. And a lot of money was available back in the late 90s, early 2000s, and that money will never be available again. And so the money that was available to dig up the streets, to put in these fiber optic cables, will not be available again. And so whatever fiber that is in the ground is super valuable, and it's a fixed cost business. And for a long time, I watched this for a long time, and we owned level 3 for probably, people that might remember, 4, 5, 6 years where it never made any money, because the volumes kept going up, but it still hadn't gotten up to the break-even point. But the volumes were growing, the traffic volumes were growing at 100% a year. And so in my little mind, it goes, oh my God, if you're compounding anything at 100% a year, eventually it's going to come to a huge number. And eventually that fixed cost business is going to get above break even, and then it's all going to turn to cash. And that happened in level 3 probably 6 years ago maybe. And then they've levered it even more by doubling their fiber optic footprint with the merger of CenturyLink. And now we've got the leadership of level 3 managing, and I would say it's not the best culture and leadership that we've got, but they're good and they're solid. And their CFO in particular is absolutely brilliant. And they're going to need him because they put together a very complicated situation with a lot of debt, and there's nobody I would rather have at that helm than Sudha Patel. What he did in managing through level 3's problems is nothing short of brilliant. And putting these two companies together is going to be a challenge, and the debt load is a bit of a challenge, and paying that huge dividend is a bit of a challenge. But for Sudha Patel, that's fallen off a log compared to what he did at level 3, because they were going bankrupt. And he put it all back together again. He is extraordinary. We are very excited about CenturyLink. Yes?
I was wondering, of the companies that you invest in, how many of them actually are aware of Kaizen and practice that philosophy purposefully? And how many of them just have CEOs that are just kind of naturally know they have that gift?
That's a really good question.
And then also in the United States, in the culture of business today, do you see that criteria, that philosophy in companies growing, decreasing, or kind of staying the same? Which would then increase kind of, if it's growing, the pool of people, of companies you have to.
Yeah, let's start with that, and then remind me maybe the first part of the question.
So the question was, do we see more and more companies starting to practice Kaizen in the USA?
Yeah, the answer to that is no.
Okay, no, like the ones that do it
Thank God.
purposely,
And
that
then-
are aware of Kaizen,
Yeah.
and the ones that have CEOs that just have that gift, that get it to do that.
Yeah, so let me try to come at this a couple different ways. Remind me.
I need to repeat the question.
Okay. But I'm going to forget it. I need a pen.
The other part of the question is, how many of the companies that we invest in are trying to practice Kaizen? And how many of them are doing something that's similar to that, but that's not actually what they're
It's just
trying to do?
because the CEO gets it.
Yeah, I know, I get it. That's a great question. And we have some companies that just use the Deming model. They are Deming zealots. A company called Danaher, they've been doing this since back when all this Toyota stuff started to come back into the United States. It's an awesome story. We could go back and go into more detail on it if you want. And we have probably 4 companies maybe that are just use the Deming model. And we love it because it's easy for us to identify. And it's super, it's so crystal clear to us. And they just talk about it constantly, and everything refers to, in this case, the Danaher business system, which refers to the Deming model that they implement. And those are really awesome companies for us, and we love them because they're so easy to identify. And then we've got other companies that use all kinds of oddball ways to break down barriers, to empower employees, and they're even more fun because they're doing it, again, some of these managers maybe never even heard of Deming. But as you said, it's kind of ingrained into who they are, and they've created these cool ways of breaking down barriers that are away from the Deming model, but they're for us, they're even more fun, to tell you the truth.
And then my other half was, in business in the United States, are they headed that direction? Pretty much staying the same, or is it kind of going?
No, I think staying the same. And the reason is, again, because all of these things run across the grain of human nature. And there was a period. So I was introduced to Deming in 1988, and it was just at that time when Japan was going to take over the world, and we were like freaking out here, and we were pulling all these Deming ideas back, and General Motors tried it, Ford tried it. Ford actually got further than anybody, and then they kicked out Donald Peterson and brought in a Ford family member to be the CEO. And Dennis, is it Dennis? Donald Peterson got it. I mean, he was awesome, and we might have even owned Ford. But they just kicked him out like nobody's business. And what happens is every time you try to implement this, and we think every time you try to do something creative, always gets worse before it gets better. Always gets worse. And particularly when you're trying to change a culture, oh my God. Always gets worse, and you got to stick through it. And you got to enable people to be able to make these decisions and make these mistakes and walk away. And say, it's okay, and you just shut yourself into a room and scream and then come back out again. It's not easy to do. And what happens, and we had it, and we had a company actually that in 1988, I bought it as a cheap stock before we found this criteria. It was JLG Industries. And I just pulled it right out of it was a cigar butt type cheap stock, a pure Ben Graham company. And then I got introduced to this, and they were a manufacturing company. They made aerial work platforms. And I had developed a relationship with the chief financial officer because they were a pretty small company at the time. And I started telling him about the Deming stuff that I was learning about. And he goes, yeah, we're kind of looking into that stuff too. And then they started learning about it at the same time I did. And they would send me their, the brochures or the training manuals that they were using for their employees, and we were trading information. It was really, really cool. The unique thing about JLG was it was Chuck Diller, Rau Bobapelli. It was the marketing guy, the manufacturing guy, the engineering guy, and the finance guy were all totally bought into it. There's one guy that wasn't, and that was JLG, John L. Grove, who invented the product. And it was a very typical thing, very old line kind of manufacturing guy. And he said, oh, yeah, well, you guys go ahead and try that. But, in the back of his mind saying, well, that'll never work. And so they went through a recession hit them, and it's a very cyclical business. And the business went off a cliff. And the team's idea was great. We're going to, instead of lay everybody off, we're going to put them in a classroom for 6 months. And we're going to really pound this into them. And John Grove said, no way, ain't gonna happen. And the difference was the whole team bought into it. And there was a day where the security guards came out and escorted John Grove out of his own company. And from that day on, we were totally committed to JLG. And it went 100 times over about a 15-year period. It was a monster until it got bought out.
Take a break?
Yeah, let's take a little break, and then we'll come back, do maybe another 20 minutes. How's that? So there was a question at the break, I think I'm going to take the advantage of the question and kind of give out a piece of information that I kind of wanted to anyways, as to what changes might be occurring in some of the companies, positive or negative. And so we talked a lot about our two favorite companies, Cognex and Rogers. And maybe I go a minute into the Rogers story.
Can Ginger put the names of the companies up?
Yeah.
Thank you.
That's the most important one.
That is. And so, just a brief, Rogers is another situation that's gone multiple fold since the inception of the fund. And I don't know exactly what the cost basis was, but I'm assuming it's probably around $20 a share. Got to 177 and has recently backed off to under 110. And the story on Rogers is that what they make is plastics or polymers that go into a variety of different industries. But I was introduced to the company in 1988, and in 1988 they had a very small division that made printed circuit boards material for the aerospace industry. For very, very, very high frequency communications, which was only used in the very smallest end of aerospace communications. And they were actually having a big debate. They had 80% or more market share at the time. And it was just they came at it with actually a Teflon product originally. And the challenge at very high speed communications is that as the circuitry travels on the printed circuit board, it heats up. And as it heats up, the signal gets distorted. And so to eliminate the distortion of the signal, they came up with a Teflon, this is back in the 60s, came up with a Teflon-based material, and it had great properties, and they owned this little niche of the industry, but it never grew. And they were very concerned back in 1989 or 1990 that it was a business that had to keep putting R&D resources in to keep the cutting edge, and that there just wasn't any growth in it. It was a very small division of a very small company at the time. And that high frequency that was only used in aerospace at the time is now in your pocket. And so this is, the interesting thing about the business is, so most of what these printed circuit boards go in are these boxes that go into cell towers. And a box may cost $20, $30, $40, $50,000 per unit. And people that know, understand, have some experience in electronics know that there's always cost pressure on electronic devices, constantly, pounding down the prices, and you have to reduce their prices all the time. And the difference between what Rogers does and the rest of the industry is that the material that goes into that box that might cost $20,000, $30,000, might be $4. And so, are you really going to care if you pay $4.50 or $4 for a product that if you pay $4.50 or $5 for a product that makes that box, work much more effectively? And so, in this arena that nobody has pricing power, they have pricing power. And it's a small enough business, and they're a small enough company, but it's a small enough business where it won't attract somebody to come in and throw $1 billion out of it to unseat them. And what's happened recently with Rogers is that we're going through a technological change from something called 4G to 5G. It is a major, Jason, you could chime in here. But it's a major leapfrog in the technology, and it's difficult to do, and it's taken a fair amount of time, and there's so many things that 5G is going to do that 4G couldn't do, but the boxes that go into these towers just has not really started to. They haven't really started to spend the money yet, but it is pending. And Rogers sees there's at least 4 or 5 times more material in 5G 5G per box than 4G, and there's going to be more boxes, and we think this thing is just going to roll out over the next 10 years probably as people find more and more uses for the technology. And so, Rogers, in our classic way, is taking the long-term approach, and they're doing everything they can to. These are big. It's kind of a fixed cost business because they're big presses that they use to make these printed circuit boards. And so they're building out their capacity as fast as they can, but they don't have the revenues yet. And it's temporarily hurt their earnings. And that's why the stock, in addition to the market correction that we've had this year, you add that on top of a minor shortfall, actually, in their earnings because they're spending money to make sure they have the capacity for the 5G rollout. And the stock's dropped from 177 down to 110. And as you can imagine, we are buying every share we can get our hands on in here. And we've owned them since 1988. We know who these people are. And we know this business. There's so many unique characteristics to it. And we think actually the wireless business is not nearly as good as owning the cable. Because the wireless business, you got to keep spending money all the time to replace the boxes, and then the technology changes, and then you just throw the box away. And you got to start all over again. You don't have anything tangible like fiber in the ground. And so it's not a good business. We don't think it's a good business for the people that, I would not want to be invested that much in a wireless network company. Because they just got to keep spending all the time to stay alive. And don't get anything tangible out of it because they got to keep doing it again. But that's great news for Rogers. So on the wireless side, we like the Rogers situation. And on the wireline side, we like owning the backbone, which is the CenturyLink story. Hey, Ian.
So real quick, sorry. There's now more water. Dom just went and got a big jug of
Thank you,
water.
Dom.
So if anyone wants more water.
You mentioned just throwing the box away, which brings to mind a question I had about what kind of consideration do you give to a company with regard to its environmental philosophy?
Yeah. So
the quick, if I can just rephrase
oh yeah,
the
sorry.
question.
I'm gonna go back again.
So
Criteria.
what do we look at in terms of environmental? But I'm going to add social and governance. We call it ESG, environmental, social, and governance criteria and issues.
Sure.
So for us, it comes into having a long-term focus. So if you're doing something that harms other human beings in some form or another, we think it's a liability somewhere down the road. Extractive industries we don't think are great long-term businesses because they're being the resources being extracted all the time. And traditionally, I'd be open if it ever happened, but traditionally they do not have progressive cultures. So we've never really had any exposure to that, and it's not early in my career. We did some of that. I bought, we owned a water purification company at one point. I was seeking them out. We owned an air pollution control company, and I thought I was doing something really good and cool, and they were lousy companies, and we lost a lot of money. And that wasn't fun for me, it wasn't fun for the investors. And so we think this does both things. We think it's super responsible. We don't call it socially responsible, but what could be more responsible than treating your employees well, in our opinion? And B, we think companies with a long-term focus, why would you want to own a cigarette company if of some liability down the road of people dying of it? I mean, it just doesn't make sense for a long-term owner of a business. And so we think the result is that we not only get the best companies you could possibly find, but we think they're the most responsible companies from our perspective. And everybody has a different perspective on what's responsible, but we've actually taken an additional step recently to identify ourselves as,
ESG,
yeah.
environmental, social, governance oriented.
And this is a program that Dominic's been working on for before he left, and then now again when back started again. And we never really wanted to promote it, and we've been doing this for 30 plus years and have never promoted it that way, because we've seen a lot of companies promote themselves as being socially responsible, and then we think the only reason why they did it was a marketing ploy, which we think was totally irresponsible. But we've actually hit some lists as far as our performance is concerned that has gotten some national recognition. And a whole bunch of money came into us over the last couple of years. And then our first quarter wasn't as good as our longer term track record. And all that money went back out again. And so we think that if we identify ourselves as ESG, what is it again?
Environmental, social, governance oriented.
Yeah, that if we can keep producing world-class performance, that those people are more apt to stick through us when we go through a bad quarter.
So part of all of this is this kind of idea that we're sharing information and we're breaking down barriers. That's a lot of that is internal inside the company. A lot of that means transparency. A lot of that means also, though, breaking down barriers between inside the organization and other stakeholders, shareholders, employees, managers, but also community members, the environment, those types of things. So when we see companies that focus, for instance, on environmental factors, that for us is a green flag for us. That it's an indicator that they're doing something that we like within our criteria. A lot of so-called ESG funds will have a negative screen, meaning we will invest in the entire universe of companies, but we won't invest in mining, or we won't invest in pornography, something like that. We actually, have kind of some of those kind of screens, as Russ was alluding to, but also we have more positive screens. We have we use it as a positive factor. If we can.
Yeah, we think this is proactive, where most ESG kind of investors, they just pull out what they think are the bad stuff. We actually think we're proactive, and we got our own environmentally social conscious right in our office, because Dominic was an environmental science major, and he's not going to let us get away with too much in that area, I would think. Paul.
Yeah, do you have any updates for us on what you're seeing in and how you think about bonds, the bond market?
Yeah, so
the question is.
Yeah, sorry.
The question is, any updates on our stance on bonds in the bond market?
So we've taken a stance. We don't have the time to go through it tonight, but we think the most dangerous bubble of all time is the situation of these interest rates that have, over about a year ago at least, were as low as they've ever been in the history of capitalism. And when when interest rates go up, bond prices go down. Most investors are, particularly baby boomers, are heavily investing in bonds because they think that there's no risk involved, and we think the risk is super, super significant. And we have gone cold turkey since 2009 and have not bought a bond since 2009, up until 6 months ago. And the rates finally started to break on the upside, and they broke. We didn't know exactly how they broke, but the way they broke was the short-term interest rates came up first, and the bonds with the least amount of risk are the ones with the shortest maturity. And so we are buying 3-month treasury bills that are yielding 1.85% as we speak. And we have no intention of going out further than 3 months until this thing normalizes. And what we've been doing is just rolling those 3-month bills every time they come due. And a year ago, you would have gotten nothing for that. And the 30-year bond, I looked at it today, was under 3%. And the 3-month bond is almost 2%. Why in God's green earth would anybody expose themselves to that kind of interest rate risk for 30 years when they could get the majority of that yield for 3 months?
So what would you consider normalized?
Well, the peak of the interest rate cycle was 1982, and that was when Paul Volcker attempted to break the back of inflation, which he effectively did. And that same 3-month treasury bill that actually at one point in time in the cycle was negative, a year ago was 0, at the peak of the cycle in 1982 was 21.5%. So 6%, I don't think is an outrageous concept. And if you look at lowering corporate tax rates in an almost unresponsible way, creating larger deficits, increasing prices through tariffs. These are all factors that would lead to inflation, and inflation would lead to higher interest rates. So could it go beyond the mean? I would say it's a possibility. Bobby T.
Why is J.P. Morgan Chase on this list?
Oh, that's a really good question.
Why are we investing in J.P. Morgan Chase?
Yeah, so we've been really dedicated to this concept of the bond bubble breaking. In retrospect, never ever publicly bet against a bubble. It's a painful thing to do because you don't know when it's going to break, and you got all the force coming in one direction, and you're standing there by yourself. And it hasn't been a pleasant experience, but part of that concept was when the bubble breaks that banks that were not fudging by buying longer-term maturities for their investment portfolios, which would hurt them when the rates went up. If they were very disciplined in doing that, that when the rates went up, the majority of the loans that banks normally have float. And so they would get, it would be an immediate windfall to the profit margins as long as they didn't get caught up being greedy and trying to milk more out of the short term. And so originally, and we've done this a few times in our career, that, you know, an easy way, if we're looking to do something, and Warren Buffett has done it in a massive way, it's the good seal, the golden seal of approval. Not the golden seal, what is it? Good housekeeping seal of approval. And we've successfully done that over the years several times. And so I'm somewhat embarrassed to say that it was Wells Fargo that we chose. And when these issues hit, I think when I'm 87 years old, I could be, maybe I'll be a little sloppier than I am today, maybe not as precise. But anyways, I think this thing was a little deeper than certainly Buffett would probably like to. I mean, he's too committed to pull out of it at this point. At that point in time, they are cleaning themselves up. But when the news came out, we had just started to purchase it, and so we were dead even. And so I still wanted the concept, and so my second choice was J.P. Morgan, and we have total confidence that Jamie Dimon was not going to fudge to make his quarterly earnings look good. But the real answer is also that it's less than 1% of the portfolio. So we really didn't have the conviction to go any further than that. And we got our position, it went straight up, and we just left it alone. And I don't think we're going to add to it at all. We would have owned a lot of Wells Fargo if that had occurred. We were on the path of owning a bunch of it. Andrew? All right. Any other questions?
So, this is maybe a little off the subject. What do you think about how if these tariffs go through, how they're gonna affect the market?
So,
The question is.
Oh yeah.
Sorry. Again, I fell down on my job. The question is, if these tariffs and the kind of tariff war and tariff battle does actually occur in the tariffs.
You don't need to expound upon it.
How are they going to affect the market?
So, if you even in the slightest amount start to include one's politics into your decision making on this, you're toast.
You make the decision.
I know.
I don't make the decision.
No, I was just saying that's the broad framework that I'm going to start the answer with. So if we could detach ourselves from the politics of it all, okay,
Yeah.
and just look at the reality. We think that lowering the corporate tax rate the way they did was like taking a fire, throwing gasoline on it, and then taking a flamethrower to it. And I think it would have been dangerous, things would have gotten tremendously overheated if that was the only thing that was done. Now suddenly we have something coming in that is counterbalancing it. And so it's counterbalancing what we think might have been a situation that could have gotten overheated. The rationale for anything is a whole different subject that there's no way I want to get into. But the two somewhat balance each other out.
Thank you.
But both things, in our opinion, are going to lead to higher inflation, which is going to mean higher interest rates and a worse problem for fixed income investors. Barbara?
2 weeks ago, your office sent an excerpt or video of the J.P. Morgan and Warren Buffett news article about going away from quarterly reporting or quarterly goals. And I was wondering what your opinion was on that whole thing. Are you reinforcing what they were promoting? Because it sounded like people would not get up-to-date reports because they wanted to go from quarterly goals.
Oh, no, they still want to have all the data quarterly.
Okay.
They still want all, I'm sorry.
Yeah, question is, Warren Buffett and Jamie Dimon wrote an op-ed piece about getting away from quarterly reporting, and what's your opinion on that?
Yeah, so they're not talking about getting away from quarterly reporting. They want more quarterly reporting, to tell you the truth. What they don't want is quarterly guidance. So what all these companies do is they tell, in a quarterly earnings report, they say next quarter we're going to make 35 cents. And so then all of a sudden, if it looks like they're going to make 33, they do something stupid just to make sure they aren't called a liar. And when they make 33, the stock goes down. And so they want to get rid of quarterly guidance. And the whole principle is to get managers to look longer term. And we're obviously all in favor of that. We think it'll never happen. And we think that's our great advantage, is by identifying companies that are willing to report bad earnings or to not. We have many companies, probably a third of our companies at least, do not do quarterly guidance. Or they might do yearly guidance. Or they do guidance within a huge range. but they are somewhat non-traditional in the way they give guidance. All of our companies are, one of our primary criteria is that they're super long-term oriented, and Buffett is trying to get more companies to think that way, and he can move the needle a little bit, but human nature is to take the shortcut. It will always take the shortcut. But I give them, a lot of kudos and total respect for taking on the issue, which nobody else is willing to do.
Question follow-up is, these brokers want, investment advisors and brokers are saying, don't they put out some of these things, or are they quoting just company?
Yeah, they quote the company.
Yeah, because I was thinking maybe the brokers were trying.
Yeah, some companies say, well, if we don't do it, then the analysts are going to do it. And it's not, we'd rather do it so we can at least give a reasonable number out there rather than something that doesn't make any sense. That's the argument on the company side why they should give guidance, so that the analysts aren't going off in nowhere's land. That's sort of part of the debate. But we have no, all of our companies are long-term, so we don't have really a dog in that fight for us personally.
I would say the bottom line for us is that we expect companies that will make decisions for the long term, and if that means that their short-term earnings don't look as good as they should or as someone else expects, that's fine for us. And then that creates an opportunity to buy, because if their short-term earnings miss the guidance that's out there, then the stock price sometimes or often will go down.
Yeah, so the Rogers story was classic, that they were, plowing all this money into expanding their capacity and showed a couple of soft quarters because of it. The Cognex story is similar. The largest, they don't like people talking about who they supply, people supply to them, but the largest electronics personal manufacturer in the world is a big customer of theirs. They're very secretive, even with their suppliers, about what they're doing. They've had, in the last 3 years, they've given Cognex huge orders for their products. They go primarily into, they buy a bunch of machine vision manufacturing products when they transition from one generation product to the next. And so the iPhone 10 came out last year. They spent a whole bunch of money on machine vision with Cognex. And this year, they're kind of riding the 10 through the year without having a major product transition. And so that big order now is less. We don't know exactly what it's going to look like, but we think it's going to be less than it was last year. And Cognex is actually, not only not cutting their research and development, but stepping on the accelerator because their opportunities are so extraordinary, and it's hurt a couple of their earnings reports. And they've asked them on their calls about cutting back R&D because the Apple or the big manufacturer's order is less, and they just scoff and move on to the next question. Jordan.
Going after the same video she was referencing, what do you think the implications of the joint healthcare proposal by Berkshire and Amazon and JP Morgan Chase?
So Jeremy, I want you to ask the question and then answer it.
Okay. The question is, what are the implications of the new healthcare company being formed jointly by JP Morgan Chase, Berkshire Hathaway, and Amazon? The answer is I don't know. But here's what I think, and here's what I do know. Those three companies, well, first of all, they're all on our list to some extent. And we can quibble with whether Amazon is actually on the list or not. But what we do know is that Amazon checks several of our boxes 100%. They don't check all of our boxes, but some of them they do. And Berkshire is about as good as it gets in terms of many of these criteria. So we have 3 companies that we like and 3 kind of visionary leaders that we like that are trying to do something to revolutionize this huge, extremely complicated problem that is as big of a problem as there is in the United States. And in my opinion, who would you rather have doing it than the greatest investor and one of the world's biggest insurance companies and best insurance companies, one of the world's biggest finance and bank, and obviously the one that we like, and one of the world's greatest technology companies, all trying to get together, thinking outside the box to try to figure this thing out. Plus, they have a ton of employees combined between the 3 companies, so for them, the stakes are extremely high. If they can figure out a way to lower healthcare costs and improve the lives of their employees, the benefit to them is huge. And then if they can do that in a way that's replicable, the benefit to society can be huge. So I have no clue where it's going to go, but I'm glad they're doing it and not me.
And it's super admirable would be my comment.
Is the Amazon holding from the Whole Foods acquisition? Or
No, well, sort of.
So the question is, why do we have a little bit of Amazon, and is it because we loved Whole Foods?
Jeremy spent the day there. We probably won't get into the details on it, but very few people have spent the day at Amazon. And the stock just never, I mean, what they've done from a long-term perspective is unbelievable. And the fact that they could do it in a way that got Wall Street to buy into it is so unbelievable. It's regardless of anything else about Amazon, just the fact that they were able to do that is like so incredible to me. And then the stock actually went from 1,600 down to 1,300. The first time I've seen it in years. Even take that much of a move, and I couldn't stand it, and we bought 0.02%. And I kind of like having it in there. And if you own something, you follow it in a whole different way. And I want to always know what Amazon is doing from a lot of different perspectives. And the fact that I'm going to now, work on it and research it on a different level because I own even a little bit of it, I think is going to provide some benefits over time, not financially, but through just knowledge, learning-wise.
And there were a couple people that had this discussion at the break, but if you go back to the criteria, Amazon, knocks it out of the park with a couple of these criteria.
Well, one of them for sure.
And purpose and passion and long-term focus.
Yeah.
And misses incredibly on a couple of them.
Yeah.
And so for us, it's a.
But we know who John Mackey is. And I can envision what that conversation looked like. And Bezos has said it, that one of the primary reasons why he wanted to own Whole Foods was that they would like to change their culture. And what better model to do it than Whole Foods? And Bezos is a very smart guy. And if he's smart enough to recognize that, we'll see where it goes. You get so embedded in the way you do things, you might not ever be able to change. If it does, oh my God, Mackey's gonna, really have a hard time. But we'll see where it goes. And owning it enables me to have a little more of a window than we would have otherwise. So we did it. I was actually surprised I did it, and I'm kind of glad I did it. But it's not going to impact the portfolio one way. And we're ahead, but it doesn't impact the portfolio.
What are the shares going for right now?
1,700 and change. We bought it at 1,300. Well, it's getting super late.
Next question was, does everybody get to come in an hour later in the morning?
And the
Well,
answer is
yes. I've got, my buddies are in from out of town, so I might not come in at all tomorrow morning, so. All right, thank you everybody for coming, really appreciate it.